Welcome to the deep dive. Look, if you're gearing up for a big regulatory exam or just trying to navigate the complexities of the construction business, staring at a huge pile of reference books can feel, well, overwhelming.
Totally overwhelming.
So our mission today is super specific, really strategic. We're taking that the Florida statutes, the guides, the big Contractors Manual, and we're essentially building you a map, a functional, quick reference map.
Yeah, think of it like a strategic guide, not just a summary. The goal is simple. When you hit a question, whether it's on the exam with the clock ticking or, a real problem pops up on a job site,
Right.
you need to know instantly where to flip. This isn't about memorizing everything. It's about knowing exactly where the answer lives. It's your reference guide for solving problems fast.
Okay, so let's lay out the core materials we're mapping today. These are the standard trio for Florida contractor certification in 2024, right?
That's right. You've got the big one, the multi-chapter Contractors Manual. Everyone just calls it the CM. Huge book.
The beast.
Yeah, exactly. But then you have these two, I call them quick flip essentials. Smaller but vital. Florida Statutes, Chapter 455, that's the professional regulation baseline, and then the Builder's Guide to Accounting, which is all about the practical money side.
Got it. CM 455 and the accounting guide.
And here's the immediate strategy tip, kind of a heads up right from the start. The exams and, frankly, the regulators in real life, they lean heavily on the Florida-specific stuff.
Meaning the statutes.
The statutes, yes, Chapters 455 and 489, and the parts of the CM that cover things like liens, licensing deadlines, workers' comp exemptions, the recovery fund details.
The Florida-only rules.
Precisely. The general business advice in the CM is good, it's necessary, but the gotcha questions, the things that can really trip you up or cost you big time, they live in those state-specific regulations. That's where the highest risk is.
Okay, so focus heavy on the Florida specifics for the high-stakes stuff. Makes sense. All right, let's start with those non-CM books then, the quick flip essentials, as you call them. Smaller, maybe, but packed with rules you just have to know.
Exactly. You should probably have these tabbed up already. First one, Florida Statutes, Chapter 455. It's officially titled Business and Professional Regulation.
Okay, 455. What's its main job?
Think of it as the state's overarching rulebook for all licensed professions, not just contractors. It covers the basics. Getting licensed, renewing, what happens if you mess up disciplinary actions, fines.
So penalties live here.
Absolutely. If you see a question asking about a specific fine amount or the minimum standard for something that could get your license suspended or revoked, chances are Chapter 455 is where you look first. It's the enforcement backbone.
Now, people often get confused between FS 455 and FS 489. 489 is the specific contractor licensing law, right? So why is 455 the first stop for penalties?
That's a great question. FS 489 drills down into the nitty-gritty of construction licensing, the types of licenses, the scope of work, things like that. But 455 sets the general framework for professional conduct, financial responsibility, and, crucially, consumer protection across the board. It establishes the baseline rules and the consequences for breaking them. 489 builds on that, specific to construction.
Okay, so 455 is the big picture for rules and consequences. Give us some core examples, the high-stakes info that's really rooted in 455.
Right. Well, minimum financial responsibility requirements are detailed here, like proving your company has a certain minimum net worth, which varies depending on the license type you're going for.
Okay, net worth minimums. What else?
The big one for consumers is the recovery fund. You absolutely need to know about this.
Yes, the recovery fund. Always seems to cause confusion. Why does the state even have this, and what are the key numbers to know?
It exists mainly for consumer confidence. If a licensed contractor does something really bad, think gross negligence, fraud, and they can't or won't pay a resulting civil judgment.
Like if they just disappear.
Or declare bankruptcy, yeah. The consumer who got burned can apply to this state-run fund to get some compensation. But, and this is critical, it's not unlimited.
Right, there's a cap.
A hard cap. You need to know this number.
Yeah.
$25,000 maximum payout per claimant per incident. That's it.
So if a homeowner wins a $50,000 judgment against a shady contractor...
The recovery fund will only pay out a maximum of $25,000 from the fund itself. The homeowner still has to try and collect the rest directly from the contractor, if they can. That $25K cap is designed to protect the fund's solvency, not necessarily make every victim whole. You will see questions testing that limit.
25,000. Got it. And what about the fines? You mentioned those are in 455 too. Like, say I'm a licensed GC and I hire an unlicensed sub to save some money. Bad idea, I know. But where's the specific penalty spelled out?
Bad idea is right. And yes, you find the disciplinary actions for aiding and abetting unlicensed activity right there in 455. Even for a first offense, the fine can go up to $5,000.
Wow, 5 grand just for hiring someone without checking.
Yep, and it escalates quickly. If you get caught contracting without the proper license yourself, that can become a felony offense. So 455 is definitely your map for enforcement and penalties.
Okay, that's the heavy legal stuff. Now let's shift gears completely. The other quick flip book, The Builder's Guide to Accounting. This sounds much more practical, less about shall not and more about how to.
Exactly. This guide is your practical finance manual. It's not statutes. It's about running a construction business that actually makes money and stays solvent. We're talking fundamental construction accounting.
Like job costing.
Job costing is huge in it, yeah. Cash management strategies. How to properly allocate your overhead, that's a big one. And understanding the different taxes you deal with. Income tax, sales tax, payroll taxes. It breaks it all down.
Why is overhead allocation such a focus?
Because that's where a lot of contractors bleed money without realizing it.
Yeah.
You know, the cost of the office, the trucks, insurance, administrative staff. Those costs have to be spread accurately across all your paying jobs. If you don't allocate enough overhead to each bid.
Your profit vanishes.
Right. But if you allocate too much, your bids are way too high, and you don't get any work. This guide gives you the methods, the math, for finding that sweet spot.
So if I get an exam question that gives a scenario, maybe a contractor underbid because they forgot about office rent and liability insurance, this guide is where I'd find the correct way to calculate that bid.
Precisely. You look for the section on overhead allocation methods. It will show you how to calculate that burden rate and apply it properly.
Are there other specific numbers or percentages in this guide that tend to pop up? Tax details, maybe?
Yeah, sometimes. Things like the specific percentage you can deduct for business meals, for example. That kind of detail is more likely to be in this practical guide than buried in a statute. It's also the resource for diagnosing financial problems.
How so?
Well, if a question says, your company's profit margin is shrinking, what financial area should you investigate first? The answer, often guided by this book, usually points towards scrutinizing your job costing and overhead allocation. Are all costs being tracked and billed correctly? That's the kind of practical application this guide provides.
Okay, quick flip books covered. Now we dive into the big one, the Contractors Manual. Chapter 1, Business Planning. This feels like starting right at the beginning.
It is the beginning. This chapter forces you to think about the absolute first major decision you make. How are you structuring your business? What's the legal entity?
And this isn't just about taxes, right? This is fundamental to protecting yourself.
Absolutely. It's huge for liability. Chapter 1 lays out the main options: sole proprietorship, partnership, the LLC, limited liability company, and then the corporations, S Corp versus C Corp. It gives you the pros and cons of each.
So if my main concern is keeping my personal assets, my house, my savings separate from business debts or lawsuits, where in Chapter 1 do I look?
You go straight to the entity comparison chart. It's usually a table in that chapter. It clearly shows which structures offer that personal liability protection.
Yeah.
The LLC and the S Corp are generally the go-to choices for contractors. Specifically for that reason, they create legal separation.
Let's play that out. Say I install a pool, something goes wrong, causes major water damage to the client's house, maybe $300,000 worth. If I'm just operating as Joe's Pool Service, a sole proprietor,
You're totally exposed. Your personal bank accounts, your house, potentially even your spouse's assets, depending on how things are titled. It's all fair game to satisfy that debtor judgment.
ouch. But if I'd set up as Joe's Pool Service, LLC,
Then generally speaking, the liability stops at the business's assets. They can sue the LLC, take the LLC's bank account as equipment, but they usually can't come after your personal home or savings. That chart in Chapter 1 makes this distinction crystal clear. It's why this chapter is foundational.
okay, liability protection is key. What about the other big differentiator, taxes? Particularly that double taxation issue people mention with C Corp. Where does Chapter 1 explain that?
It explains it in the C Corp section. Double taxation is a classic C Corp drawback, especially for smaller businesses. The corporation itself pays income tax on its profits. Then, if the corporation distributes some of those profits to the owners, shareholders, as dividends.
They get taxed again on their personal tax return.
Exactly. Taxed once at the corporate level, taxed again at the individual level. That's the double hit. For most small to medium-sized contractors who want profits to flow through directly to them, an S Corp or LLC, which are typically pass-through entities for tax purposes, makes more sense. Chapter 1 guides you away from the C Corp, unless you have very specific reasons, like seeking major outside investment.
Makes sense. Chapter 1 also covers the startup basics, right? Like, how do I actually form the company legally in Florida?
Yes, it points you in the right direction. It'll mention the Florida Division of Corporations, which runs the sunbiz.org website.
Some does, okay.
Chapter 1 outlines the kind of documents you need to file, like articles of incorporation for a corporation or articles of organization for an LLC. It also touches on initial business planning steps, things like doing a SWOT analysis.
What?
Strengths, weaknesses, opportunities, threats. Basic Business Planning 101, just to get you thinking strategically before you launch. It's all about setting that solid foundation. All right, so Chapter 1 sets up the business structure. Chapter 2, licensing, is all about getting and keeping your authority to actually operate as a contractor in Florida. Think of this as your compliance shield against the DBPR, the Department of Business and Professional Regulation.
This chapter sounds critical, probably pulls information from those statutes we talked about, 455 and 489.
Exactly. It synthesizes a lot of the rules from FS 455 and the contractor-specific FS 489 into one place, focused on the licensing process and responsibilities. It covers applying for the license, the exam process itself, and crucially, the roles and responsibilities of key personnel.
Okay, let's get granular on those roles. You often hear about the QA and the FRO. What's the difference, and where does Chapter 2 define that?
Good question. It trips people up. Chapter 2 defines them clearly. The QA, or qualifying agent, is the person who holds the actual technical license. They pass the exam, they have the proven knowledge and experience. They're responsible for the supervision of the construction work itself.
The person who knows how to build things.
Right. The FRO, the financially responsible officer, is different. Their role is solely about the money side, ensuring the company meets its financial obligations, demonstrating financial stability to the state.
Can one person be both?
Yes, in smaller companies, it's very common for the owner to be both the QA and the FRO. But the state views the responsibilities as distinct. Chapter 2 details what's required to prove financial responsibility, things like minimum net worth, maybe posting a bond or getting a letter of credit if your financials are borderline.
This chapter seems like another place full of potential landmines, especially deadlines. What's the absolute must-know, time-sensitive deadline that lives in Chapter 2?
Hands down, it's the 60-day deadline for replacing your qualifying agent.
60 days? That seems fast.
It is. If your company's designated QA leaves for any reason, they quit, retire, get sick, whatever. Chapter 2, referencing FS 489, states the company has exactly 60 days to notify the DBPR and designate a new qualified QA.
What happens if you miss that 60-day window?
The company's license is automatically suspended, operations halt. You cannot legally contract until a new QA is officially in place.
Wow, no extensions. What if you're a small shop, just one owner who is the QA, and they get seriously ill?
Unfortunately, the statute, as interpreted in Chapter 2, is generally very strict on this. The 60 days is the hard rule. The state sees the QA as essential for public safety, the link between the license and competent supervision. If that link is broken, the privilege to operate is paused, a really critical deadline to have mapped.
Okay, 60 days for QA replacement, critical. Does Chapter 2 also revisit the recovery fund stuff from FS 455?
It does. It often reiterates the mechanics and links back. It might provide a bit more context or perhaps include flowcharts related to the claim process. It reinforces that $25,000 per incident payout limit we talked about earlier.
And does it add any other details, maybe about costs associated with making a claim?
Yes, sometimes you'll find clarification here regarding the claimant's costs. For instance, it might specify that the claimant's attorney fees that can be recovered from the fund are capped often at something like 25% of the actual award amount paid by the fund.
Ah, so another limit to know. Keeps the fund from being eaten up by legal fees?
Exactly. It's all about preserving the fund while still offering that layer of consumer protection. Chapter 2 is really your central hub for understanding the rules of being licensed.
All right, Chapter 3 moves us from getting licensed to actually managing the money day to day, financial management. This sounds crucial, especially for trades with big upfront costs or seasonal swings like pool builders maybe.
Absolutely essential. If Chapter 2 is about permission to operate, Chapter 3 is about staying in operation by managing cash effectively. It gets into the nitty-gritty of budgeting, how to calculate your markup correctly.
Markup versus margin, right.
Yes, understanding the difference is key, and it's explained here. It also covers invoicing procedures, handling progress billings, and a really important topic, retainage.
Okay, let's zero in on retainage. That seems to cause a lot of friction between GCs, subs, and owners, especially on public jobs. Where does Chapter 3 give us the hard rules?
Chapter 3 spells out the basics
Mhm.
and usually references the specific statute for public projects, which is FS 255.05. That statute puts a strict cap on retainage for state and local government jobs.
And that cap is?
Maximum of 10%. That's a number you need to know. The government client cannot hold back more than 10% on a public works project.
10% max on public jobs. And when does that retained money have to be released? What's the trigger?
The trigger, as defined in Chapter 3 in the relevant statutes, is substantial completion.
Substantial completion, not final completion with every little punch list item done.
Correct. Substantial completion means the project, or a specific part of it, is complete enough that the owner can occupy it or use it for its intended purpose. Maybe the pool is full and the pump works, even if some landscaping needs finishing touches. At substantial completion, the retainage related to that work should generally be released, minus perhaps an amount covering the value of the remaining minor items.
And if the client agrees it's substantially complete but still drags their feet on releasing the retainage, does Chapter 3 give me a timeline for recourse?
Chapter 3 sets the stage for demanding payment. It explains the expectation of payment upon substantial completion and outlines the documentation needed. Your ultimate enforcement tool is the lien law, which is Chapter 9, but Chapter 3 tells you when you should be demanding that retainage release based on project milestones.
Got it. Beyond payment mechanics, does Chapter 3 talk about record keeping? Like, how long do I need to hang on to invoices and financial documents?
Yes, it covers administrative compliance, too. It usually references the standard recommendation, often driven by IRS guidelines like IRS Publication 538. The magic number is typically 7 years.
7 years? Why so long?
It mainly relates to audit periods. The IRS generally has up to 6 years to audit you in certain situations, so keeping records for 7 years provides a buffer and covers most statutes of limitations for financial disputes or potential fraud claims. It's just good practice, and Chapter 3 highlights it.
Okay, 7 years for records. One last scenario for Chapter 3. My monthly report shows negative cash flow. More money went out than came in. Where does this chapter suggest I look for the immediate fix?
Negative cash flow usually screams receivables problem. You've done the work, spent the money on labor and materials, but you haven't collected payment yet. Chapter 3 will guide you to focus immediately on accelerating your receivables, meaning tighten up your invoicing. Send invoices out the day work is done, not weeks later. Follow up aggressively, but professionally, on overdue payments. Maybe adjust your progress billing schedule on future jobs to get cash in sooner. Chapter 3 provides that kind of diagnostic. If cash is tight, look at money owed to you first. Okay, so we've built the structure, got the license, and looked at managing the cash. Now, Part 2 focuses on managing the inherent risks in construction. This covers Chapters 4 through 7 in the CM insurance, labor laws, workers' comp, and safety. It's about building your safety net.
Right, Chapter 4, risk management. This sounds like it's all about insurance and maybe bonding, protecting the company when things inevitably go wrong, a slip and fall on-site, storm damage, etc.
Exactly. This chapter is your guide to the essential insurance policies. General liability, or GL, is the big one for covering property damage or injury to third parties. It also covers workers' comp, which we'll detail more in Chapter 6, commercial auto for your vehicles, and umbrella policies for extra coverage.
Are there specific minimum coverage amounts we need to know from Chapter 4?
Yes, particularly for general liability. Chapter 4, referencing state requirements, will specify the minimum GL coverage you need to maintain your license. For many contractor licenses in Florida, that minimum is $300,000.
$300 minimum GL. So if an exam asks for the lowest legally acceptable GL coverage.
Chapter 4 is where you find that number. It's a hard requirement.
Okay, insurance covers things after they happen. What about preventing problems or guaranteeing performance before work starts? That's where bonding comes in, right?
Precisely. Bonds are different. They're a three-party guarantee. The surety company guarantees to the project owner, the obligee, that you, the principal, will fulfill your obligations. Chapter 4 breaks down the main types you'll encounter:
Sure.
bid bonds, performance bonds, and payment bonds.
Let's focus on performance and payment bonds. Are these always required, especially thinking about government jobs again?
That's a key area. Chapter 4 clarifies, often linking to statutes like FS 255.05 again, or FS 627 for insurance SIPity rules. For public projects, state, county, city jobs exceeding certain contract values, 100%. Performance and payment bonds are typically mandatory.
100%. Meaning the bond amount has to equal the full contract price.
Correct. The performance bond guarantees you'll complete the job according to the contract specs. The payment bond guarantees you'll pay all your subcontractors and suppliers on that public job. Chapter 4 makes it clear these are non-negotiable requirements for most public work.
Got it. And bid bonds. They're used during the bidding phase.
Yeah.
What's the common trap or misunderstanding about when a bid bond is forfeited? People think if they just don't win the bid, they lose the bond.
No, that's the misconception. You don't forfeit the bid bond just for losing. Chapter 4 explains the triggers. A bid bond is basically your promise that if you are the winning bidder, you will sign the contract and provide the required performance and payment bonds. You typically forfeit the bid bond if 1, you're the low bidder but refuse to sign the contract, or 2, you submitted a non-responsive bid, meaning you didn't follow the bidding instructions correctly.
Ah, okay. So it's about backing out after winning or messing up the bid submission itself.
Exactly. Chapter 4 clarifies those specific triggers for forfeiture.
All right, moving from insuring risks to managing people. Chapter 5, labor law. Hiring crews means dealing with a whole mess of federal and state employment rules, right?
The whole mess is a good way to put it.
Yeah.
Chapter 5 is your primary map for navigating those rules. It pulls heavily from federal laws like the Fair Labor Standards Act, FLSA, for wages and overtime, Title VII of the Civil Rights Act for discrimination, the ADA for disabilities, plus Florida-specific statutes like FS 438 on minimum wage and payment practices.
Let's start with the basics. Getting paid correctly. Overtime is always a big one. Where does Chapter 5 lay out the rule?
It details the FLSA requirement pretty clearly.
Yeah.
For any employee who isn't specifically exempt, like certain managers or professionals, you must pay them 1.5 times their regular hourly rate for all hours worked over 40 in a designated work week.
Time and a half over 40. Simple enough, but crucial.
Absolutely. And Chapter 5 will also reference the current Florida minimum wage. You need to know that number. For 2024, it's $12 per hour, but that number changes, so always check the current requirement referenced in FS 448 via Chapter 5.
Okay. Another huge risk area is worker classification, mistakenly calling someone an independent contractor when they're really an employee. Does Chapter 5 help draw that line?
Yes, it dedicates significant attention to this because the penalties for misclassification are severe back wages, unpaid taxes, fines. It will typically outline the IRS guidelines, often referred to as the three-factor test, or similar.
Which looks at
Things like behavioral control. Do you dictate how they do the work? Financial control. Do you control their opportunity for profit or loss? And the relationship of the parties. Is there a contract? Are they integral to your business? The takeaway from Chapter 5 is, if you control the what, where, when, and how of the work, they're almost certainly an employee, not a contractor, regardless of what you call them.
That's a critical distinction. What about non-discrimination rules? ADA compliance.
Chapter 5 covers your obligations under federal laws enforced by the EEOC, like Title VII, no discrimination based on race, religion, sex, etc., and the Americans with Disabilities Act, ADA. A key point under ADA highlighted in this chapter is the requirement to engage in the interactive process.
Meeting.
If an employee discloses a disability or requests an accommodation, you must have a conversation with them to explore whether a reasonable accommodation is possible that doesn't cause undue hardship for your business. Chapter 5 stresses that simply ignoring the request is a violation in itself.
Okay, got to talk it through. And documentation. What about the paperwork side of hiring?
Chapter 5 covers the essentials. You've got the Form I-9, which is mandatory for verifying employment eligibility for everyone you hire. It will also mention E-Verify, which is required for many Florida employers, especially those with public contracts.
E-Verify, okay.
And critically, Chapter 5 emphasizes child labor laws. You need to know the restrictions, especially preventing workers under 18 from performing hazardous duties, things like operating heavy machinery, roofing, or excavation work. Big liability there.
Now, workers' comp gets its own chapter, Chapter 6. You mentioned it earlier, but this chapter dives deep, and you said this is super Florida-specific and penalty-heavy.
Absolutely. If there's one insurance area where Florida has unique and strictly enforced rules for contractors, it's workers' comp, governed by FS 440. Messing this up leads to stop work orders, massive fines, even criminal charges. Chapter 6 is your survival guide here.
Okay, let's hit the main point. Who must be covered? Is it every single person working for a construction company?
Pretty much, yes. The rule laid out in Chapter 6, based on FS 440, is that if you're in the construction industry in Florida, you must provide workers' comp coverage for all your employees, right from employee number 1. There's almost no small employer exception like in some other industries.
No exception. What about the owners? Can they opt out?
That's the main exemption, but it's tricky, and Chapter 6 details it carefully. Corporate officers can file for an exemption, but there's a cap.
A limit on how many can be exempt.
Yes. A maximum of 4 officers per corporation can exempt themselves. And there's another crucial condition often tested.
Which is?
They typically must own at least 10% of the corporation to be eligible for the exemption.
Ah. So you can't just name 4 managers, vice presidents, and have them opt out. They need real ownership skin in the game.
Exactly. 10% ownership and officer status limited to 4 people. That's a classic Florida workers' comp rule found in Chapter 6. Miss that nuance, and you could be violating the law.
Okay, 4 officers, 10% ownership minimum. Now the really scary part. Subcontractors. This seems like where GCs get caught all the time. What's the absolute rule from Chapter 6 regarding subs and their insurance?
This is non-negotiable and a major focus. As the general contractor, Chapter 6 mandates that you must obtain proof of workers' comp insurance, usually a certificate of insurance, from every single subcontractor before they or any of their employees start work on your job site.
Before they even step foot on the property.
Before. Not after they start, not when you get around to it. Before. Because if you let an uninsured sub work and one of their employees gets hurt on your job,
The liability falls back onto my company's workers' comp policy.
correct. Your insurance carrier will likely have to cover the claim, your premiums will skyrocket, and the state can still fine you heavily for allowing uninsured work. Chapter 6 makes it clear. Verify that certificate up front every single time. Keep copies.
That verification step sounds like the core risk mitigation here. What kind of penalties are we talking about if you fail to comply with these workers' comp laws under FS 440 as outlined in Chapter 6?
They are severe and can be criminal. Chapter 6 highlights things like stop work orders shutting down your entire operation, significant fines often calculated based on avoided premiums, and workers' comp fraud like lying about payroll to lower your premium or working without coverage is classified as a felony.
Felony, wow.
Yes, potentially leading to jail time and fines that can reach up to $100,000 or even more. Chapter 6 doesn't mince words about the seriousness of workers' compliance in Florida construction. If the question is about employee or sub-insurance requirements, Chapter 6 is the go-to source.
Okay, Chapter 7 brings us right onto the job site itself. Safety. This has got to be dominated by OSHA regulations, right? Lots of specific numbers and rules.
Exactly. Chapter 7 is heavily based on OSHA standards, particularly the construction standard, 29 CFR 1926. This is where you find the hard, quantifiable rules for keeping a site safe. If you see words like minimum height, maximum depth, required spacing, reporting deadline in a question, think Chapter 7 and OSHA.
What about record keeping? Does OSHA require specific logs?
Yes. Chapter 7 details OSHA's record-keeping requirements. The most well-known are the OSHA 300 log for tracking work-related injuries and illnesses, the 300A summary, which must be posted annually, and the 301 incident report for details on each case. It also defines what constitutes a recordable incident versus just first aid.
And what about reporting serious incidents directly to OSHA? Are there thresholds?
Yes, very specific thresholds and tight deadlines. Chapter 7 spells these out. Any work-related fatality must be reported to OSHA within 8 hours.
8 hours? That's incredibly fast.
It is. And any inpatient hospitalization, amputation, or loss of an eye must be reported within 24 hours. Missing these reporting deadlines brings its own set of penalties.
Okay, 8 hours for a fatality, 24 for hospitalization. What about the common hazards on site? Fall protection and trenching seem like big ones. What are the key numbers from Chapter 7 there?
Those are 2 huge ones, definitely covered. For fall protection and residential construction, Chapter 7, reflecting OSHA rules, typically mandates fall protection systems, like guardrails, safety nets, or personal fall arrest systems, when workers are exposed to falls of 6 feet or more.
6 feet, got it. And trenching, excavations.
For trenching and excavation safety, the critical depth is generally 5 feet. Any trench 5 feet deep or more requires a protective system, shoring, shielding, like trench boxes, or sloping the sides back to prevent cave-ins. Working in an unprotected trench over 5 feet deep is a major, often fatal violation.
6 feet for falls, 5 feet for trenches. Those seem like numbers you just have to know.
You do. And Chapter 7 is full of these kinds of specific ladder safety rules, like how far a ladder must extend above the landing
I
point.
think it's 3 feet, right?
Usually 3 feet, yeah. Rules for scaffolding, electrical safety, personal protective equipment, PPE. It's all detailed, practical site safety stuff mandated by law.
This chapter really drives home that point you made earlier about codebook keywords.
Absolutely. Chapter 7 is almost pure codebook. It's packed with words like shall, must, minimum, maximum. When you read those words here or in the statutes like 455, 489, 713 lien law, or the workers' comp chapter CH6 FS 440, you know you're reading a non-negotiable legal requirement.
As opposed to the handbook language.
Right. When you're in Chapter 1, business planning, or the accounting guide, or even Chapter 10, project management, you see more suggested, recommended best practice. That language signals advice or methodology, not necessarily a hard legal mandate you can be fined for immediately ignoring. Recognizing the difference must versus should is key to prioritizing compliance versus operational efficiency, and Chapter 7 is firmly in the must category. Okay, final stretch. We've covered setting up, getting licensed, managing money, risk, and safety. Part 3 is about the project's lifecycle, the contracts that define the work, the laws that protect your payment, and the process for properly finishing and closing out the job. Chapters 8, 9, 10, plus the AIA documents.
Chapter 8, Construction Contracts. This seems fundamental. Moving beyond handshake deals to something legally binding, especially when things go wrong.
Exactly. This chapter covers the basics of contract law as applied to construction. What makes a contract valid? You need offer, acceptance, consideration, something of value exchanged, and legal capacity. It also touches on the statute of frauds.
Which means?
Which generally means certain types of contracts must be in writing to be enforceable. For construction, this often applies to contracts that can't possibly be completed within 1 year, or contracts involving goods over a certain value, sometimes $500. Chapter 8 will also highlight specific clauses that must be included in Florida construction contracts by law, referencing FS 489.128, like limbo warnings.
Okay, basic contract formation. What about managing changes during the project? Scope creep is a killer. Where does Chapter 8 address change orders?
It emphasizes the critical importance of written change orders. The core rule hammered home in Chapter 8 is, get it in writing and signed before you do the extra work. Don't rely on verbal agreements for changes in scope or price.
Because if you do the work first,
you have very little leverage to demand payment later if there's a dispute. A signed change order is your proof of the agreement to modify the original contract. Chapter 8 stresses this as essential for financial control.
What if a dispute arises anyway, even with a contract? Does Chapter 8 outline the typical resolution process? Timelines?
Yes, it usually covers dispute resolution clauses common in contracts. It might discuss negotiation, then mediation, then potentially arbitration or litigation.
Yeah.
It often mentions standard timelines, like if a contract requires mediation, there might be a mandated period, say 30 days after a formal dispute notice, where the parties must try to mediate before filing a lawsuit.
Okay, mediation first. And Chapter 8 also connects to another Florida statute, FS 558, regarding construction defects, right? Why is knowing about that process important?
Critically important. FS 558 creates a mandatory pre-suit process for construction defect claims. Before an owner can sue you for an alleged defect, they must send you a formal notice of claim detailing the problem. Chapter 8 explains this process.
And receiving that notice triggers?
It triggers specific rights and deadlines for you, the contractor. You typically have the right to inspect the alleged defect, the opportunity to offer to repair it, or offer a monetary settlement. Chapter 8 highlights that you usually have a set time frame, often 45 days, to respond to that 558 notice. Knowing this process exists and where to find the rules, Chapter 8 FS 558 can help you resolve issues before they end up in court.
All right, Chapter 9, Construction Liens. You called this the exam hotspot, the Bible for getting paid. This sounds like maybe the most critical chapter for a contractor's financial survival.
I'd argue it is. Florida's mechanics lien law, FS 713, detailed in Chapter 9, is complex, unforgiving, and absolutely essential to understand. If you don't follow the procedures and deadlines exactly, you lose your right to place a lien on the property, which is often your only real security if the owner doesn't pay. Errors here are costly.
The key seems to be the deadlines. You mentioned a timeline chart. Is that the first place to look if a lien question comes up?
Absolutely. Find the lien timeline chart, usually in the appendices or within Chapter 9 itself. If the question involves how many days or within X months, that chart is your immediate go-to reference. It visually lays out the critical sequence.
Okay, let's nail down the 3 most vital deadlines from that chart or chapter, starting with the notice to owner, the NTO. Who sends it and when?
The NTO is crucial for anyone not in direct contract with the property owner. So subcontractors, subcontractors, material suppliers. They must send the NTO to the owner, and usually the GC, to preserve their lien rights. The deadline? Within 45 days of first furnishing labor or materials to the job site.
45 days from the very first day you start work or deliver materials, not from when you invoice.
Correct. Day 1 starts the clock. If a sub starts work January 1st but doesn't send the NTO until, say, March 1st, they've missed the 45-day window. Their lien rights for that job are likely gone. It's incredibly strict.
Wow, 45 days for the NTO for those not in privity. What's the next big deadline? Filing the actual lien.
Yes, the claim of lien itself. This document gets recorded in the public records. The deadline for recording the claim of lien is within 90 days from the date of final furnishing of labor or materials under your contract.
90 days from your last day of work.
Correct. Final furnishing. Not substantial completion, but your actual final work or delivery related to the contract. That's another hard deadline.
Okay, 45 days for NTO, 90 days for claim of lien recording. And once it's recorded, does the lien last forever?
No, definitely not. The third critical deadline is the enforcement period. Once your claim of lien is recorded, you generally have only 1 year from the date of recording to file a lawsuit to foreclose on that lien.
1 year to sue.
1 year. If you let that year pass without filing suit, the lien automatically expires and becomes unenforceable. Poof, gone. Those three deadlines, 45 days NTO, 90 days claim of lien, 1 year enforcement, are the absolute backbone of Chapter 9.
Chapter 9 must also define key terms like notice of commencement, right? Why is that document important?
Very important. The Notice of Commencement, NOC, is a document the owner records before the project starts. Chapter 9 explains that it officially marks the beginning of the project for lien purposes and establishes lien priority. Crucially for subs and suppliers, the NOC contains the legal name and address of the owner, the GC, the surety, if any, and the lender, if any, all the info you need to properly serve your NTO. Chapter 9 tells you where to find the NOC, usually public records, and what info it must contain.
Makes sense. What about getting rid of a lien? If an owner disputes it or wants to clear the title, can they bond off the lien? Where's that explained?
Yes, Chapter 9 covers contesting liens and the mechanism of transferring a lien to a bond, often called bonding off. If an owner needs to clear the property title, maybe to sell or refinance, they can post a surety bond with the court. This removes the lien from the property itself and attaches it to the bond instead.
Does the bond have to be for the full lien amount?
More, actually. Chapter 9 specifies the required amount for a transfer bond. It's typically the amount of the lien claim plus interest plus attorney's fees, often calculated as 125% or even 150% of the lien amount, depending on the exact calculation method referenced. This ensures the claimant is fully secured by the bond, even though the lien is off the property, knowing that percentage calculation might be important. Okay, Chapter 10. Project management. This feels like it pulls everything together, taking the contract, CH8, managing the risks, CH4 to 7, and applying it to the actual execution and completion of the job.
Right. Getting the project built efficiently and then wrapping it up correctly. What kind of tools or techniques does Chapter 10 focus on for scheduling?
It typically introduces standard scheduling methods like Gantt charts, the visual bar charts, and, more importantly for complex jobs, the critical path method, or CPM.
CPM, what's the key concept there that Chapter 10 would highlight?
The core idea of CPM, explained in Chapter 10, is identifying the specific sequence of tasks that determines the project's minimum completion time. That sequence is the critical path. Any delay to a task on the critical path directly delays the entire project completion date.
And that relates to float time.
Exactly. Float time, or slack time, is the amount of time a task not on the critical path can be delayed without affecting the project's final deadline. Chapter 10 explains how understanding float helps project managers prioritize. If task A is critical, 0 float, and task B has 5 days of float, you focus resources on keeping task A on schedule. It's essential for managing resources and subcontractors effectively.
Makes sense. So scheduling is key. What about finishing the job? Quality control and final paperwork, where does Chapter 10 cover that?
It covers quality control processes, often mentioning punch lists, the list of minor items needing correction before final acceptance, and then it details the crucial closeout documentation phase.
What absolutely needs to be handed over to the owner at closeout, according to Chapter 10?
Key documents usually include as built drawings showing the final locations of things like pipes and wires hidden in walls, warranties for equipment installed, and operations and maintenance O&M manuals, especially for complex systems like HVAC, pools, or specialized equipment. Chapter 10 will stress the importance of providing these for a smooth handover.
O&M manuals, okay. And leaning releases too, presumably.
Absolutely. Chapter 10 ties back to Chapter 9 here, emphasizing the need to collect final lien releases from all subcontractors and suppliers and provide a final release yourself upon receiving final payment. It might even include examples of standard lien release forms, like conditional versus unconditional releases.
And warranties, does it specify standard durations?
It often references the warranty requirements found elsewhere, like in the Florida Building Code, FS 553. Typical construction warranties might range from 1 year for general workmanship up to maybe 4 years or more for specific systems like roofing, depending on the code and contract specifics. Chapter 10 reminds you of these obligations during closeout. Hashtag TAG the AIA documents, contract administration reference.
Okay, last section of references. The AIA documents. These aren't chapters in the CM, but standardized contract forms that pop up a lot, especially on bigger commercial jobs or architect design projects. The key here seems to be knowing which document number covers what.
That's exactly the strategy. The AIA documents are highly detailed, but for exam purposes or quick reference, you mainly need to know the function of the most common ones based on their number. They're mostly about procedure, roles, and administration.
All right, let's hit the big three. First, AIA A201. General conditions of the contract for construction. Sounds foundational.
It is. The A201 is often incorporated by reference into the main owner-contractor agreement. It sets the ground rules for the project. It defines the roles, rights, and responsibilities of the owner, the contractor, and the architect in great detail.
So if a question asks about, say, the standard process for submitting shop drawings or the architect's time frame for reviewing them,
That procedure is likely spelled out in the A201. It covers things like communication protocols, how changes are handled administratively, insurance requirements, dispute resolution steps, procedures for claims and delays, termination conditions. It's the administrative playbook for the project. Knowing A201 governs the overall project administration is key.
okay, A201 for the big picture admin. What about the relationship between the GC and the subs? Is there a standard AIA form for that?
Yes, that's the AIA A401, standard form of agreement between contractor and subcontractor. If the question is specifically about the legal relationship, payment terms, or obligations flowing down from the GC to a sub, the A401 is the relevant document.
What kind of specifics would be in the A401?
Things like the subcontractor's scope of work, often referencing the prime contract, payment timing and conditions, pay if paid versus pay when paid clauses, insurance requirements for the sub, and very importantly, indemnity clauses.
Indemnity, meaning the sub has to cover the GC if the sub messes up. Essentially, yes. The A401 details the extent to which the subcontractor agrees to indemnify or protect the general contractor from losses or lawsuits arising specifically from the subcontractor's work or negligence. Understanding the flow down of risk via the A401 is crucial for GCs.
Got it. A401 for subrelations. One more. What if the question is purely about the bidding process itself, before any contract is signed? Like how bids should be submitted or when they can be withdrawn?
That falls under the AIA A701, Instructions to Bidders. This document is provided to all potential bidders before they submit their price. It lays out the rules of the bidding game.
Such as?
It specifies exactly how bids must be prepared and submitted, sealed envelopes, deadlines, etc., whether a bid bond or other security is required, the owner's right to reject bids, the process for handling questions or issuing addenda during bidding, and the conditions under which a bid can be withdrawn before the bid opening. It's all about the procurement procedure.
Okay, so A201 General Admin, A401 Subcontractor Agreement, A701 Bidding Instructions. Knowing the number points you to the right area. That's the navigational trick for the AIA docs. Match the question type to the document's purpose. Hashtag tag OTRO.
Wow, okay. We have definitely covered a lot of ground, effectively building that reference map for Florida contractors navigating these crucial materials. I think the real takeaway here is that strategic approach you mentioned at the start.
Right. It's not about carrying every single rule in your head. It's about knowing where to look based on the type of question or problem you're facing. That saves critical time, whether you're in an exam or dealing with a real-world fire drill.
So let's recap that navigation strategy one last time. If the problem involves state-imposed fines, licensing requirements, minimum financial standards, or those recovery fund limits,
You jump straight to the statutes, FS 455 for the general professional rules and penalties, FS 489 for contractor-specific licensing. Don't wade through the whole CM first for those hard legal answers.
and if the issue is about business finance, calculating overhead correctly, understanding job costing methods, figuring out tax implications, managing cash flow,
That's the Builder's Guide to Accounting. It's your practical financial methodology resource.
and the big Contractors Manual. It's the detailed map for everything else, but certain chapters are key navigation points.
Exactly. Chapter 1 for business structure and liability protection. Chapter 2 for the core licensing rules and QAFRO rules. Chapters 4 and 6 for the huge risk areas, general insurance, bonding, and especially Florida workers' comp mandates. And Chapter 9.
Chapter 9 for the lien law, the absolute must-know for getting paid.
The Payment Protection Bible, yes. Knowing those key chapter destinations within the CM is crucial.
And this all ties back to that really insightful distinction you made about the language used in these sources, the code book versus handbook language.
Right, recognizing whether the text uses shall or must versus suggested or recommended tells you immediately if you're dealing with a hard legal mandate or operational guidance. The compliance chapters and statutes, 455, 489, 713, 440, Workers' Comp 6, OSHA 1067, are full of musts.
While the business planning, CH1, accounting guide, and project management, CH10 sections, lean more towards shoulds or how-tos.
Exactly. They guide efficiency and profitability, which are vital, but the musts dictate legality and the right to operate at all.
Which brings us to a final thought, maybe a provocative question for you, the listener, to consider as you manage your own business or study for that exam. If compliance rules are mandatory, musts, and profitability methods are often suggestions, shoulds.
Then where should you be focusing your limited time and resources right now to ensure both survival and success? Is it shoring up the administrative compliance from Chapter 2, like ensuring you have a plan if your QA leaves unexpectedly, hitting that 60-day deadline? Or is it rigorously mastering the payment protection deadlines in Chapter 9, that 45-day NTO clock, the 90-day lengths of filing to guarantee your cash flow? Balancing that mandatory compliance with practical solvency, that's the tightrope every contractor walks. Where does your focus need to be today?